If we look at the global economy, it's a proper reset. There are themes that we think are going to have a big impact in how the global economy works going forward. The first one is the geopolitical fracturing, deglobalisation, essentially where trade routes are being remade. So it's fracturing on a couple of levels. So there's trade, we see it with the trade taxes from US President Trump. And then there's fracturing across financial fracturing, essentially payment mechanism. A lot of countries saying if we are trading between us, perhaps we need to trade in our own currencies and not through a third currency, which is the dollar. That is gaining momentum. The dollar can be used to sanction countries that don't behave as expected, at least from a US perspective. So countries are saying perhaps it's too risky for us to depend on one payment system, so we need alternative rails.
This government has pulled back on aid to Africa. And yet, in any crisis, there's an opportunity. And there's a lot of conversations now about saying it's no longer a focus on aid. It now could be a focus on trade. And we know, for example, that China has been building a strong relationship with Africa and built trade relationships.
It's really a change in how countries are doing trade. When China shows up, they say we can build you a road, a railway line, infrastructure or manufacturing capacity, and in return we need access to your minerals, which are important for all sorts of manufacturing process. Historically, the US would push aid a lot, use that as soft power, soft influence to get access to minerals. But that has not been significantly positive from a developmental perspective for most African countries. Because after the US is gone, aid has been used to finance current spending. You don't have anything left that can actually be a growth positive for the economies.
We're living through one of the most uncertain and rapidly shifting global environments in decades. Geopolitical tensions are rising from the Middle East to Eastern Europe, and trade relationships are being rewritten, and the capital is moving in ways we haven't seen before. And in the middle of all this sits Africa, a continent long spoken about as the next frontier, but now facing a very real inflection point. As global aid declines and traditional partnerships are reshaped, Africa is being pushed, perhaps for the first time at scale, towards a model driven by trade, investment, and self-sustaining growth. I'm Paul Miller, and this is the CEO Lens, where we step back from the noise and look at the world through the lens of leadership, strategy, and long-term value creation. And today, we're asking a fundamental question. Is Africa ready to transition from a recipient of aid to a magnet for investment? What will determine which countries win, which fall behind, and how global forces will shape that journey? To unpack this today, I'm joined by Isaah Mhlanga, the Chief Economist of RMB. So Isaah, right now in the world, it's going through such a geopolitical shift, and we're seeing a lot of challenges still in Eastern Europe, Middle East. There are wars that continue, how the various countries are relating to each other, the trade agreements that have been structured. It seems everything is now up for debate, and the world is going through a reset. Can you talk a little bit around that to us and what's happening and make some sense of it for us?
Certainly, and thanks for having me here, Paul. Look, I think if we look at the global economy, to your point, it's a proper reset. It started with the COVID pandemic, and from there onwards, we saw quite significant changes that says to us the world is not going back to how it was before. There are a couple of themes that we think are going to have a big impact in how the global economy works going forward. The first one that you allude to is the geopolitical fracturing, deglobalisation, essentially where trade routes are being remade. So it's fracturing on a couple of levels. So there's trade, we see it with the trade taxes from US President Donald Trump. And then there's fracturing across financial fracturing, essentially payment mechanism. A lot of countries saying, hang on, if we are trading between us, perhaps we need to trade in our own currencies and not through a third currency, which is the dollar. That is gaining momentum, but also that gains momentum because of the weaponization of the dollar. SWIFT and the use of the dollar, it can be used to sanction countries that don't behave as expected, at least from a US perspective. So countries are saying, perhaps it's too risky for us to depend on one payment system. So we need alternative rails so that we can continue to trade with other countries should we find ourselves penalized or sanctioned. So that's financial fracturing. And then we see other themes that relates to how the global economy functions. Post-COVID, many countries borrowed to deal with the pandemic. Debt levels have increased significantly. Now, there are a couple of ways through which countries can deal with debt. The first one, which is the most durable, is to increase economic growth that can then generate the tax revenues that can be used to finance or to pay back the debt. That's very difficult. In our own economy, we know how difficult it is to lift economic growth to 2%. Yeah. Globally, it's the same. It's very difficult to lift global growth, but there are some countries that are growing quite fast, and we'll talk about that later on. And then the other avenue is to hike taxes, but that's difficult again. We have our own experience. We tried to hike VAT by 2%, and that was pushed back quite aggressively. We ended up with 3 budgets, and eventually we sorted it out. But that is a demonstration of how difficult it is to increase taxes.
And we saw those challenges in East Africa.
Absolutely,
right?
In East Africa as well, yeah.
Where there's a lot of pushback, where inflation, taxes were all coming under question.
Absolutely. And then if you can't hike taxes, the other avenue is to cut spending. Which spending can you cut? Post-COVID, many countries introduced short-term measures to try and deal with COVID. They have never been able to remove that. In our own economy, the Social Relief of Distressed Grant, the SRD grant, was introduced as a short-term measure, but it's still here, which means it's difficult to cut spending once you have introduced it. Which then leaves the last avenue as a potential tool which countries can pull, which is to devalue your currency, create some inflation, and reduce the real value of debt going forward. That's the theme that we thought, and we still think the US dollar is undergoing through. Essentially a weaker dollar structurally in an attempt to create some inflation and reduce the real value of US debt to deal with that. So this is broad theme. And then you have other themes like demographics. Asia has an aging population. China in particular, they had a one-child policy before. Now that's aging, they would need new workers. But at least they are industrializing and automating so they can deal with the labor issues, at least that way. And then you have Europe also aging, which leaves Africa with the youngest population globally, 19 years median age. So this influences migration dynamics between countries that can also be political. And then you have AI and digitization. Big theme, the growth of use of AI over the last 5 years have been exponential. Yeah. Still expected to be exponential in the next 18 months or so, or a couple of years, which comes with cybersecurity issues, which means companies have to think quite strongly about how do they protect their own data, but also how do they use data to actually drive their business performance going forward. These are the big themes that will continue for some time. The one aspect that we need to be comfortable with is really the existence of conflict, wars, uncertainty. This becomes more normal now than we have experienced it in the last 20, 30 years.
So I want to pick up on that theme. Getting comfortable with being uncomfortable. And we know now that in the Middle East, the crisis continues, the war continues, and that has had some significant ramifications on many countries. We should unpack that. What are those implications and how's that showing up?
Indeed, the Middle East war comes after the Russia-Ukraine war, which continues. So it's bubbling in the background. But because the world have understood and found ways to work around it, it's fallen on the back burner. We now have the Middle East conflict, disruptive for energy markets, particularly oil and gas, but it's also disruptive for other commodities beyond the top line, oil and gas. Think about sulfuric acid. It's a derivative of oil. Think about fertilizer. It's a derivative of oil. Those two, they're quite important in the manufacturing process for sulfuric acid, but for agriculture, if you think about fertilizer, now those have been disrupted. It has ramifications elsewhere. But the channels are propagated in two ways. There's the direct one, and then there's an indirect one. The direct one is oil price go up, fuel price, petrol and diesel go up immediately. We just experienced that in the South African sense, more than R5 per litre. If you look at current estimates for the next fuel price increase for next month, again, more than R5 per litre if we take current oil price estimates. So that's direct. And then the transport costs for all manner of goods that are shipped through road also increase, which then eventually go into overall inflation. Inflation goes up. Central banks don't like inflation, and we have seen it post the Ukraine invasion by Russia. Inflation is a politically sensitive issue. When prices increase, populations can protest. Governments have been changed because inflation is too high. So there is an intolerance to inflation. So central banks are bound to respond in a similar way that they responded to the Ukraine conflict. Hiked interest rates, the cost of living increases quite significantly. It's your borrowing rates for bonds, for purchasing cars, the cost of capital in general increases. So that's we already saw, which means if we continue to see oil price remain quite elevated, 100 or above $100 per barrel, we must expect this to be eventually what comes through. That's the direct impact. The indirect impact comes through trade. The trade disruption that's taking place is quite impactful. But for Asia, which has a big dependence on Middle East for its source of oil, that then becomes another leg of impact. Asia will be impacted if they get less, supply of oil. It means they are going to experience lower growth. And as they experience lower growth, their demand for commodities that much of Africa sells to Asia declines, which means there is a trade channel that we have to be aware of and prepare of. That's a second round, but it's much more long-lasting.
Looking at one of the biggest trading partners in Asia is China. Where do they get their oil from, and how's that been impacted?
So they had, two primary sources. The one was Venezuela, which is now under American control. And then the second one is Iran, of which the US is now in conflict with. So essentially you could think about it this way. This oil conflict is meant to reduce China's competitiveness, to slow down from catching up to the US. So if you close their source of supply in Venezuela, which have been achieved, and then next, if you are able to close their supply from Iran, they will potentially have less energy availability from an oil perspective and slow down their catching up to the US economy. But there are winners and losers. If you think about from a price perspective, China used to buy Iranian oil at less than $60 per barrel, discounted price because Iranian oil has been sanctioned. Now oil is set at $100 per barrel. So Iran is a winner because they continue to sell, but selling at significantly higher price. Russian oil has now been removed off sanctions, which means the Chinese can tilt from Iran to getting Russian oil. So they still continue to get access to access to energy, but not at the same price, which means there's some competitiveness that is going on.
I suppose there are even winners coming from Africa from the oil perspective.
Absolutely. The oil producers, we have Nigeria, we have Angola, we have Ghana, could also talk about Libya. All of those, they tend to do better when oil prices improve. If you look from a fiscal perspective, fiscal revenues, they increase, which means they tend to do better from a fiscal perspective. They can spend on things like infrastructure and other important spending when oil prices are high. So those are beneficiaries. But there are also losers in the process. Almost all countries that are oil importing countries in the African regions, they are net losers. an increase in oil price is almost like a tax on growth, which means you have a lot of countries whose tax on growth coming from higher oil prices are going to negatively impact these economies. But the impact is not uniform. There are some countries which have a higher share of fuel in their CPI baskets. They become the bigger losers. And then you have some countries that have lower shares of energy in their CPI baskets. They become less losers, or losers to a smaller extent compared to the other countries.
The way you're talking about Africa, you're starting to segment Africa beyond just being a continent. And you're starting to describe that there are different countries, over 54 countries, and each of those countries fall into regions. And I think the temptation always is for us to see Africa as one country, a continent. But the way you're describing it now, it seems that there are different regions with different requirements and different challenges and opportunities.
Absolutely. And this is particularly important for offshore investors. Investors outside of the continent tend to lump Africa as just one country, low income, poverty-stricken, with a host of issues, whether from a governance perspective, one blanket across the board. But that's an incorrect way of looking at the continent. It's 54 countries, different governments, different laws, different languages even, and cultures and subcultures, some of which are far more advanced than others. But also if you look from a market size perspective, they're also quite different. Take, for instance, you can take Namibia or Lesotho. You could even put Botswana there. There are countries each of about 2 million people in terms of populations. Some of them landlocked, which means that they don't have the same dynamics as a Nigeria and Egypt and Algeria that have large populations, but also that have access to the sea. So those countries will be different. And then you can think about a Mauritius, an island, or a Seychelles, an island. If you look at Seychelles, 100,000 people or 120,000 post their change in terms of visa regimes to allow skilled people into the country. They have different dynamics. So it's 54 countries that are different. If you also look from a regulatory perspective, they're quite different markets as well. You have some that have pegged exchange rate, particularly West African countries that are pegged to the euro. And then you look at some countries which had parallel exchange rates, but they're doing the reforms. Nigeria had a parallel exchange rate. It was difficult to take money once you put it in. They are doing the reforms. You now have one exchange rate that can facilitate price discovery and valuations of all assets. They have done the reforms, which means there's an improvement. But this just to trying to say there are different dynamics in the African continent. There are risks, but there are a lot more opportunities that you can actually find in the continent. Perhaps the way to look at it is to look at regional economies, because they tend to be driven by common fundamental economic drivers, if you think about the long-term growth. But still, you have nuances between those economies.
So let's unpack it a little bit further. What we have seen happen in the last year is the US government has pulled back on aid to Africa. And for many, I think, particularly in the health sector, it's a point of anxiety to see that health aid being removed. And yet, in any crisis, there's an opportunity. And there's a lot of conversations now about saying it's no longer a focus on aid. It now could be a focus on trade. And we know, for example, that China has been building a strong relationship with Africa and built trade relationships. Let's break it down then. Let's talk about what has China done, and then more specifically, what is the US aiming for now, whereas they move from an aid-based relationship with Africa to a trade-based relationship?
It goes back to when we started the conversation, a reset that's taking place. It's really a change in how countries are doing trade. To your point, when China shows up, they say, we can build you a road, we can build you a rail line, we can build you infrastructure or manufacturing capacity, and in return, we need access to your minerals, which are important for all sorts of manufacturing process and decarbonization and AI. Historically, the US would push aid a lot, use that as soft power, soft influence to get access to minerals. But that has not been significantly positive from a developmental perspective for most African countries. Because after the US is gone, aid has been used to finance current spending. You don't have anything left that can actually be a growth positive for the economies. So the US has changed. A recent policy on Africa or approach to engaging with Africa changes that to say we are going to engage with African countries on their own terms with the governments that exist in the countries, but from a trade, a lot more driven by trade than driven by aid. And we already saw last year the cancellation of many US aid programs that were into many African countries. Significant source of income for sectors such as healthcare, sectors such as education, safety and security, which is where most of US aid went into, is principally those sectors. It's healthcare, safety and security, and education, improvement of democratic systems. That's how it was framed. So that has been paid back. And in its place, the published intention is to increase a lot more. We can say that, as an example, the Lobito Corridor, the rail infrastructure that has been constructed from the DRC to Angola, linking with Zambia as well. That's an infrastructure that's going to outlive at least the facilitation of the shipping of commodities out of these countries. If you look at the value chains beyond that, these are value chains that can actually be growth positive for the countries through which one would also say this is an influence of China. The Chinese have been pushing the Road and Belt initiative for some time, connecting different countries. Perhaps that has influenced the approach the US is taking to say a lot more countries are now trading with China, in part because when China shows up, it leaves infrastructure. And they get a lot more reception from African countries. And of course, trade has changed. If you go 20 years ago, in 2000, you look at which country do most countries list as their largest trading partner, it was the US. Fast forward to 2024, 2025, ask the same question, the largest trading partner of many countries is no longer the US, it's China, which means the Chinese have increased their trade significantly so. And on the back of that, it's now possible for China to actually say, we're trading a lot more, can we invoice in yuan? You're starting to see a little bit of that change coming through, which is the very same thing the US wants to push back against.
Yeah. So this goes back a little bit to the conversation you were saying around potentially the cutoff for oil to China to slow the economy down.
Yeah.
This may be another means by which China is putting a counter position on the US economy. Can you break that down?
Look, if you look at how China trades, first, how China make policy, it's ultra long term, which means there is continuity in terms of implementation. They have 5-year economic policy implementations and targets, which gets revised, but still moving in the same direction to the ultra long. The Belt and Road Initiative is many years in the making. And you can now see how dominant they are. Look at vehicle manufacturing, the largest producer of electric vehicles. If you drive on the road, now perhaps the car in front of you or on either side is potentially a Chinese car. If you look at the pricing that it comes at quite cheap. So they've thought long, they have implemented aggressively, and now they're dominating from a trade perspective. What then follows once trade is there is the internationalization of their currency, where they can actually say, we're now invoicing in our currency, perhaps can we remove a third-party currency? That you're starting to see, which is the fragmentation of the financial system. For a very long time, we've traded, at least internationally, using the dollar. It's still the most dominant traded currency, still the most dominantly used in terms of invoicing, but it has been reducing, even to the extent that central banks, if you go back to about 10 years ago, central banks held 70% of their reserves in dollars. That's now just under 50%, which means there is an increase in other currencies in the last couple of years, an increase in the holding of gold by central banks. So they are also diversifying their currencies underneath. And of course, if your trade is now dominated by Chinese trade, you need your companies to facilitate that trade in the currency of the countries they're trading with. So you're going to increase the holding of Chinese yuan in your reserves. And you're starting to see that slowly. But if you take a long-term view, there is just no other way to look at it but to say the country which dominates in terms of trade, eventually its currency is also going to increase in importance.
So we've spoken a lot around how China and US view Africa. Maybe we should also look at the African governments. While commodities are highly demanded, and we know now also that you mentioned the AI component, electric vehicles, the trend towards digital, a lot of those minerals that are required for that production come from Africa.
Absolutely.
You gave some examples of the railage that the US has put down. But I suppose one of the challenges for Africa is to try and drive a stronger beneficiation of those minerals and those commodities and try and get more value in country rather than just purely be an exporter. How is that emerging and which countries are doing that particularly well?
We're starting to see some evidence of that in a few countries. But I would say it's one of the things that we actually have to put up there to say there is big opportunity for Africa, but also for investors to look at Africa as an investment destination. If they take, the continent as 54 countries, but with a larger market, if combined, over the next 20 years, by 2050, 2.5 billion of people will be in Africa with a median age of 19 years. Relative to Europe, median age is 40. So you can see in terms of the demand, Africa is going to be quite important. This is not difficult to see. China was in the same space. Now India is in the same space. Large population, youthful, eventually becomes your source of demand. So the opportunity from that perspective is there. But also if we look in terms of, endowment from a resource perspective, 30% of global mineral resources are here that are quite critical in the AI space, digitization, decarbonization. You find them in the African continent. 30% of arable land is in Africa. You would have to feed 8.5 billion people in 30 years' time. Where is that food going to come from? Africa has arable land, underutilized, can also lift people out of poverty because a lot more people that are of low value skills can participate in the agricultural sector. So it's a win-win for investors, but also for local economies. And where we are seeing some beneficiation taking place, take Nigeria, for instance, an oil-producing country that used to sell raw oil and buy back processed diesel and petrol. That has changed. We have Nigeria that has built one of the largest refineries in the last 20 years that now is a net exporter of processed mineral or processed fuel. Many African countries, given the constraint out of the Middle East, are now potentially procuring this fuel from Nigeria. Take Morocco and the automotive sector. They've built quite a good manufacturing base that is quite competitive. We were speaking earlier on, you mentioned in the medical space that you can elaborate on, that they are now pushing to say for localization. And that builds the manufacturing base in the country, which makes countries a lot more resilient. But to mention this, when COVID hit, the one thing that policymakers in Africa learned, which again is pushing for this localization, is to say there are certain aspects of the economy that needs to be driven locally, which is more about resilience, which means you must, one, have excess production of that. That's healthcare. The large countries went in front of the queue, bought all the vaccines, or even prevented vaccines from going into Africa. Now, can we produce those drugs locally and make our own economy resilient? So that's the one aspect. And it's not just in the medical space. It's in energy, we need excess energy. Because if without energy, your economy doesn't grow. So we actually need to deal with energy. It's transportation. If people can move freely, cheaply, the trade is not going to come. It's people that move first to negotiate the trade deals, then the goods can move later. So the Africa Free Continental Trade Agreement will only work if it's easy for people to move from country to country before the goods can move. Just in an anecdote, having a conversation with the CEO of one of the automobile companies that manufactures in South Africa. They tell me that to send cars to North Africa, it takes a number of days, 14 days roughly. But if they put those cars into a flight which connects in the Middle East and back to Africa, it takes 3 days. But why do we need to connect in the Middle East if we're flying from one African country to the next? If we could just take a railway line, we put cars across into Egypt on railway line, it will be much more cheaper, and potentially the cost of insurance is also going to be cheaper for trade. That trade is going to be a lot more. Many African countries have recognized that, which is why the Africa Free Continental Trade Agreement is so important. And we're starting to see some coordinated moves in terms of investment in infrastructure.
You were intimating the outside investor, and you were saying that the outside investor holds a very strong positive opinion on Africa, certain parts of Africa. And one of the areas which is interesting is North Africa, particularly you mentioned Egypt just now. What's been happening there?
If you look at just before the conflict in the Middle East, we have seen quite significant investment flows into Africa. $97 billion worth of investments, 35 of that went into Egypt in 2024.
Now this is from the Middle East?
From the Middle East, the Gulf countries largely. And that investment would naturally flow into other nearby countries, concentrated into investments in critical minerals, infrastructure in general. That has been a big driver.
And that helps diversify their economies from the UAE and
Absolutely. And to play into the AI investment that's taking place globally, you need access to those critical minerals that make a contribution. So they have been diversifying. Perhaps with the conflict, we might see a slowdown of that because they need the funds to reconstruct after the damage that have been caused from the conflict. But the long-term trend still holds. 30% critical mineral deposits, and you still need that's still going to be required in the global economy.
You mentioned the health sector up north. Of interest for us in the health sector is that Morocco, Algeria have made it very clear local manufacturing is a requirement. If you are to produce locally, you do get preferential access to the market. That means that the importer of that product is blocked as a local manufacturer. Also, what that means is that your price points are probably referenced off the European pricing, which is a better price point than what you see typically across Africa. And then lastly is your registration process of your drugs is so much quicker. So your ability to build a business is that much faster and is protected for the long term. So I think those are other examples where we see access to an economy doesn't just mean importing in.
Absolutely.
It means participating.
Absolutely.
And adding value. Maybe we could move down south, because up north you're seeing growth rates of 6, 7, 8% in the GDP on the
East
eastern
Africa
side
as well.
Strong performance. Down south we're not seeing that. What's happening?
South Africa is a dominant player there. We're the largest economy in the continent. Our influence in Southern Africa, and particularly the SACU countries, Namibia, Botswana, Swaziland, Lesotho, you could even add Mozambique and Zimbabwe and Zambia there. South Africa's influence is quite big. We have been growing at less than 1% growth over the last 2 years or so. Our growth has been hamstrung by load shedding, poor investment sentiment given the state capture years. But that has changed. We're seeing significant change and turnaround in confidence, but also in investment prospects. Offshore investors have already told us that they are a lot more confident in the economy than they have been before.
What are they seeing, Isaah, that's giving them that level of confidence?
The economic reforms. So we had the first Ramaphosa change in terms of administration. Its relationship with business has improved, where business is now being seen openly as a partner in terms of driving economic growth and not necessarily an enemy on the opposite side. A focus on a few big reforms that can turn around the economy. And then in May 2024, we now have the Government of National Unity, a multi-party government that was formed in 3 months. Yes, in our own experience, we haven't seen that. It was a little bit unsettling. But if you look from an international perspective, many countries take years to put a government together. And those governments, sometimes they collapse quite quickly. So in relative terms, I think that was quite a good development. And then I focus on a few common agreeable set of policies that are critical for the economy. They had a statement of intent with a clear focus on economic reforms. Those reforms centered around reforms in the energy sector and load shedding, which we no longer have. We didn't think about load shedding when we came to this recording. We live our life without thinking about electricity. Maybe the cost, but not its availability. We still think about water, which is another aspect which is on the reform agenda. It's water. Quite important. Have water, you can't manufacture, and you can't do much. Electricity, you can buy a generator. With water, there's no alternative. So it's a big reform area. And then logistics. We didn't benefit as much from the mini boom in commodity prices post the invasion of Ukraine, but even now, because we simply could not ship the commodities cheaply, more efficiently, because of the inefficiency of our rail and our ports. That's a big focus area. Durban Empire 2 essentially has now been given to the private sector to run. As far as rail is concerned, some 11 private sector players have been given to run 6 corridors with some 41 or 42 routes. Now that have been, it's going to be given to the private sector. They've already been allocated to that. So that's government saying we can't run these things. We need to partner with the private sector. Yet another one is local government reforms. That's coming. Essentially, water and electricity utilities at local government level are going to be ring-fenced. Essentially, the revenues that come out of that should be used for infrastructure for water and electricity. That's a big positive because historically, municipalities will collect water and electricity revenues. They use that to pay salaries and wages, and they don't invest back into infrastructure. Hence, we have so much leakages in terms of water, bad infrastructure in terms of electricity distribution boxes. That's going to change. Big change in terms of how local government runs. And if you think about it, every business, every household operates in a local municipality. They deal on a day-to-day basis with municipal services than they deal with national policy stuff. So that's quite fundamental. And just last week, the president signs a change in legislation that separates the politics from the administration in government, which means things like cadre deployment, for instance, or change in personnel that are administrators is going to be reduced. So you are likely to end up with more continuity in policy implementation and administration that is going to be quite positive. International investors see that. And because they look at South Africa relative to Turkey, relative to Brazil, relative to India, they've been seeing South Africa show up as a positive story relative to other markets. And they have been coming into the South African markets. If you look at performance of equity markets, South African equity markets relative to emerging markets and advanced economies, South Africa has outperformed since May 2024 on equities, on bonds, and on resources, on property. South Africa has outperformed, which says it's a South African story. It's not just an emerging market story. If it was an emerging market story, we would have performed in line with emerging markets, but we outperformed. This is the story of economic reforms. That investors
So Isaah, what I'm picking up here, you're saying is that someone living in America or Europe holds a stronger sentiment for the economy than business leaders do inside the country.
Absolutely.
What's going on there?
Look, we sponsor the Business Confidence Index with the Bureau of Economic Research at University of Stellenbosch. What comes out of that survey is confidence remain quite low. The latest number that we have confidence was at 47, which means only 47% of business executives that have been surveyed were optimistic about prevailing business conditions. 53 were not. And these business executives are small, medium enterprise, mid corporates, not the large JSE listed corporates. So what it simply says, 53% remain pessimistic. But if you look at the international investors that have been coming and buying South African assets, they've been saying we see a positive story. So there is a sort of a disjoint view between the international investors in capital markets and the business executives that operate in the real economy, largely small to mid-sized corporates. And perhaps the influence comes from this fact. The offshore investors, they look at a country relative to other similar countries and say, where do we see value in terms of the trajectory that these countries are going? They have been seeing South Africa show up as a positive story. And indeed, we do talk to international investors quite regularly as we market South African assets internationally. They have been seeing a positive story. So it's matched by what they have been doing. Take that to a local executive running a South African corporate. When they move out of their office, they get hit by a pothole. When they get home, a substation, the water is off. That influences how they feel generally, the sentiment, which the international investor does not experience on a day-to-day basis. So perhaps that can explain why local investors or local corporate executives have been downbeat, despite the positivity that we've been talking about, that we are seeing.
I suppose in one way, many local business leaders develop a sense of resilience.
Absolutely.
And given the geopolitical shifts and the challenges we're facing now, probably resilience is going to be one of the most critical anchors to hold on to. And I think as South Africans, we probably always plan for the worst.
That's true.
We're pessimistically confident about the future. I think that probably also puts us in a more resilient mode relative to other markets around the world that are probably spoilt with a lot more tailwinds than headwinds.
Absolutely. If I could say something on that. If you think about it, from 1994, when we came into the new democratic dispensation, there was a lot of uncertainty on how the country was going to progress at the time. You had many big financial institutions that went out of the country, essentially delisted, went into London, they came back. And then you have a few large corporates that took a long-term view on the country. If you live here and you go to your bathroom, you will see a name in one of the bathroom components. You go to the airport, if you go on the tarmac, the bus that's going to carry you to the plane, it has a name. Those are some of the companies that took a long-term view. They're now big conglomerates, diversified companies. Now, if you are where we are now, you want to take a long-term view on the country. What should you do, having observed all of this change and seeing the reforms that we are taking now? I can't think of anything else than to be confident that we are going to end up in a better economic growth environment than where we come from. Because of the reforms that are being done, they are structural and they are permanent, which means the economy is likely to do better going forward than what we have seen. And by nature, it seems South Africans are centrist and moderate. They don't like extremes, either the extreme left or extreme right, and the election outcome tells us as such, which means with a sort of centrist political dispensation that is now the government of national unity, we are likely to see a better coordination and less contestations in terms of the policies that are quite important for growth, particularly as it relates to infrastructure and service delivery.
As an individual, a South African, what can we expect as a consumer over the next 12 to 18 months?
The shock in the Middle East is definitely negative. We have seen an increase in fuel price north of 5 rand. Yes, we have a 3 rand reprieve from the national government in terms of fuel levy, but that's going to be recouped in some way or the other going forward because it has to be fiscally neutral. But once the conflict is over, oil prices recede, we should see a moderation in terms of inflation. But fortunately, our Monetary Policy Authority, the South African Reserve Bank, have managed to work together with the National Treasury to lower our inflation target permanently to 3, which means long-term inflation should settle around 3%. That reduces the cost of debt for vehicle financing, for home loans, and for cost of capital in general over the long term. That should make the economy a lot more competitive in reducing the cost of capital. So that should be positive. Yes, over the short term, inflation is likely to rise, but that should recede once the conflict is resolved.
So what I'm hearing you say is that Africa is an investment. The major economies are looking to Africa to strike deals.
Yeah.
It's moving away from the AIDS focus, which is more of a diplomatic approach to hard trade, commercial outcomes. Not all African countries are going to see the benefit of that investment.
Yeah.
Some are better set for that growth than others.
Yeah.
But infrastructure and a good partnership between government and the private sector, and putting down policies that are investment friendly remain critical at this juncture.
Absolutely.
Isaah, thank you so much for your positivity and your optimism.
Thank you so much. It's been great to have this conversation with you. And this is positivity that is grounded in evidence. It's things that we are seeing. It's not just wishful thinking. We are seeing these changes take place. And we highlight all of these things in our way to invest in Africa, which is a lot of the insights and anecdotes.
Wonderful.
Yeah.
Thanks, Isaah.
Thank you so much.